We wanted to have the balance sheet return to a more normal level, which is a level no larger than it needs to be for us to conduct monetary policy. Don't know the exact level. That will depend on really the public's appetite for our liabilities, specifically currency. To us, that's a liability, and the public has a large appetite for currency, and also reserves and other liabilities. So it'll be substantially smaller than it is now.
Welcome back. That was Federal Reserve Chairman Jerome Powell giving more color about the Fed's easing strategy for the year. And it was those comments on the balance sheet you just heard that had some on Wall Street on edge. CNBC senior economics reporter Steve Liesman is back at headquarters with more. Dovish or hawkish, Steve?
So can I pick a third choice, Melissa?
Okay.
And not dovish, not hawkish, but maybe careless?
Careless.
Wow.
Wow. Okay.
I think that this is a lot like the October 3rd comment that upset the markets when he said that we were a long way from neutral. I don't know exactly what Chairman Powell thinks, but there are estimates out there which the New York Federal Reserve gathers, which shows that on the street they expect a balance sheet of 3.5, 3.6 trillion. That is for the Fed to bring it down there from the current 4 trillion. Is that substantially smaller than it is now? Is he disagreeing with the market estimates right now? When he said back then that we're a long way from neutral, I didn't think he meant they were going to go more than 100 basis points, but I think the market saw that as potentially more than that. And I think this is a case where the Fed chairman might have been more precise. I think the first part of his thing was correctly telling what Fed policy is right now, that they want to get the balance sheet down to a place where they can conduct monetary policy without affecting it. But saying substantially smaller, there were several Fed people I talked to, observers, who kind of rolled their eyes at that comment.
I mean, it's not even back from October. It's his latest appearance, Steve, where he backed away from basically an automatic roll-off in the balance sheet, and now he's going back to. I mean, it's amazing how different the messages can be construed by the markets in such a short amount of time. It's not a period of months; it's a period of days at this point. And the question is, what can the markets believe? Does the Fed have a credibility issue in its messaging?
I think you can believe what the committee has said together as a committee. And that is that the balance sheet is going to roll off in this very predictable manner with a cap of up to $50 billion a month. And the New York Federal Reserve Bank has published a schedule as to the amount that it will roll off. And it's not $600 billion, by the way. It's more like $440 billion this year for what that's worth, and maybe $300 next year, which is to say that sometime in mid-2020, the Fed will hit that target. Here's the problem. The problem is that if I was the Federal Reserve Chairman, which, of course, and for very good reason I am not, I would have been thinking very carefully about how I was going to answer the balance sheet question. If that's the case and he came up with substantially smaller, then I'm wondering that maybe he meant to guide me that it's substantially smaller, guide the markets that way. But if he didn't mean that, then I'd be like, well, wait a second. You weren't prepared to answer that question carefully, so I don't have a good choice either way.
Steve, yesterday we had a conversation. You said the Fed is like it's an army moving forward. They hit some resistance, they regroup, but they continue to move forward. Is the resistance they meet the market going lower, and it's just going to take the market then recovers 10%? The army continues to move forward. Is that the dance we're going to do now for the next year?
I think so, and I think my sort of operating premise on this thing is how they did the taper tantrum. They came forward with the taper tantrum. The market kind of freaked out. They withdrew a little bit, waited a little time, and then came forward without much concern in terms of stopping the purchasing of assets. I think the Fed wants to be higher here under given circumstances. In other words, if the forecast comes out the way they plan it, I think the Fed does want to add, maybe 2 rate hikes from here and then kind of wait around. But it's going to wait till it has the market with it, because when Powell does say, and I think he says this with very, very advisedly, they have muted inflation right now. And it does give them the opportunity to wait. I think they'll use that opportunity in light of the market reaction here and say, hold on, we're going to chill for a bit. We're going to take a look around, and we'll wait, and we'll have the market with us. So, look, if the data comes in stronger or doesn't weaken substantially from what the Fed expects, I would still expect rate hikes here, but I don't think you'll do it in the context of a market that is violently opposed to it.
Hey, Steve, it's Tim, but despite the Army and the forward and the back, aren't you aren't you concerned about a Fed that's letting the market lead it around? I mean, that to me is the credibility issue.
Yes.
I don't like it.
Yes and no. In other words, if there was some imperative for the Federal Reserve to raise right now, if there was an obvious inflation threat, I'd be like, whoa, this is a problem. If there was a credibility problem that the Fed had to sort of claw back, I would say yes. But I think the Fed has time to wait. I don't think 50 basis points here or there in the next year or so is going to make or break either the economy or the Federal Reserve.
Steve, thank you very much.
Pleasure.
Steve Liesman back at headquarters. Powell should stick to reading off a piece of paper. I mean, that's when he gets
I
most
think you hit it on
careful,
that. He's got a messaging problem. I don't think he does it well. I think that every time he does it, he's got to walk it back. And when we look at the minutes, there's a different conversations that were taking place than what really has come through when Powell opens his mouth. So I think that either way, the market does not like higher rates. They don't like tightening. And the market is probably going to react to it in short order.
Yeah, I just want to make one comment. I mean, listening to Fed chairs for years now, I can't remember too many times where they actually mention a company and the company's guidance that they gave. He's mentioned Apple now on 2 instances. He seems to think there's some issue regarding the trade and war and how it's affecting U.S. corporations. So this is going to be a theme until we have any real progress on the trade war. And I think
that should hearten you, though, as an investor, that he has mentioned it and is acknowledging the data points from corporate America.
But the more he mentions it, the more you get nervous about why they're being dovish. That's my point. And I think at some point, the longer they stay dovish, the worse it is for a very fragile economy.
The market's all about the Fed. So that's what this has taught us. Think about how the market has totally moved on the Fed and the Fed only, remind you, down the road.